What if there was a trade that gives you a wider margin for error? If the stock goes up, you win. If the stock goes sideways, you win. And if the stock goes down low, you still win. And time decay, the very thing that usually hurts your position, will actually pay you a little bit of money every single day. That sounds too good to be true, but this is exactly how many traders use options trading. They aren't trying to guess the exact price, they aren't racing the clock, they choose a zone and let probability work for them. We've all traded options before. You've felt the pain. You buy a call, the stock nudges up, but somehow your P&L is red. Because you didn't just bet on direction, you also bet on speed, timing, and volatility. Time decay is draining your contract every day, and volatility collapses right when you need it the most. Buying options most times feels like buying a lottery ticket. You pay upfront, hope the move is fast, clean, and precise. So today, we become the house that sells those lottery tickets. I'm going to show you how to build a put credit spread. I call it the floor trade. Let's get to work. Here's how we build it. You combine two simple put contracts into one powerful trade. Contract 1, the income, you sell the put option below the current stock price. This creates your floor price where you do not want the stock price to drop through. This contract is your tenant. They pay you rent in cash up front. Contract 2 is the safety net. You buy a put option even lower than the first one. This is your insurance policy. Why two contracts? That's the genius part. The put you sell gives you income. The put you buy caps how much you can lose. Two contracts working together. As long as nothing catastrophic happens, you keep the rent. If something goes wrong, the insurance kicks in. Let's make this real. Imagine Tesla is trading at $448. You think, I'm pretty sure it won't crash below 430 in the next 30 days. You aren't predicting a moonshot, you're just predicting a floor. Here's the setup. Step 1, you sell the 430 put, that's your floor. The market pays you $3 for this, that is $300 cash credited to your account instantly. Step 2, you buy the 425 put, this costs you $1, that is $100 you pay for protection. So now you basically collected 300, you paid 100, the net credit is $200 to your account. That $200 is yours. And here's the best part. If Tesla goes to 500, you keep the 200. If Tesla stays at 448, you keep the 200. If Tesla even drops to 431, you still keep the 200. You only lose if Tesla crashes through your safety net of 430. The floor you created, and even then your loss is capped. The $5 worth of the put strike you sold and bought minus the credit $2, which means the most you can ever lose is $300. You're risking $300 to make $200. That's a 66% return on risk just for a stock to stay alive and above 430. Time decay is now working for you, not against you. You're not asking, will Tesla hit exactly 460? You're asking, will it stay above 430? That's a parking lot, not a single parking space. Now, before you go and sell floors on every stock you see, there are rules. The house doesn't gamble. The house follows a system. Rule 1, the 20 to 30% law. Aim to collect at least 20 to 30% of the width of the spread. On a $5 wide spread, you want at least $1 to $1.15 credit. Rule 2, don't put your floor right under the current price. Put your floor strike about 5 to 10% below current price. That's usually your sweet spot. Look for the Goldilocks zone. That's usually a strike price with an 80% probability of success. Rule 3, exit when you've collected 50 to 75% of your max profit. If you've made $150 of that $200 goal, take the money and run. This is how professional traders sleep at night. They don't stress about every 1% move in the stock market. They set a floor, they buy insurance, and they let time decay pay them a paycheck. Now you might be asking, how do I know the probability? How do I know if there's an 90% chance of winning. That number is called delta. In episode 5, we're going to unlock the Greeks. I'm going to show you how to read delta and theta so you know your exact odds of winning before you even click submit. This is technically called a put credit spread, but I just call it the floor. Want the opposite trade? You can build a ceiling trade, a call credit spread. Sell the lower call, buy the higher call for insurance, and get paid as long as the price stays below your ceiling. Now let's talk about assignment risk. Yes, it's possible. The house stays safe because assignment only happens if you let your floor get breached and fall in the money without reacting. Smart traders never hold naked options through expiration. If you are trading ceilings, you also need to avoid dividend weeks. Since this is a floor trade put, you don't have to worry about dividends, but the house stays alert regardless. Manage the trade, do not set it and forget it. I get a lot of pushback about profits being capped. Exactly, you are trading fantasy home runs for consistent singles. Pro traders collect premium week after week. Now, this is your homework. Look at Tesla, Nvidia, or Apple, find a stock you like, find the floor level you think holds, and you'll be shocked if it was breached. Calculate the credit, comment floor plus price plus your stock choice below. If you're ready to start being the landlord, I'll review the best ones. If credit spreads finally clicked for you, hit subscribe, like this video, and I'll see you in episode 5. Stay safe out there, trade smart.